Welcome to our mini webinar on the changes to the standard deduction and personal exemptions. My name is Steve Boisvert and I'm a CPA with Gelman, Rosenberg Freedman. We're going to focus on the main changes to the standard deduction and the personal exemptions in the Tax Cuts and Jobs Act. And then we'll move on to some potential tax planning opportunities that you may have. The standard deductions have changed, and really, in my opinion, mostly for the better, almost doubling in total from the amounts they were in 2017 to what they now are in 2018. And this could present some additional tax planning opportunities for us. So if you've watched our previous webinar on charitable contributions, you have probably already seen this opportunity. And it's the idea of bunching your charitable contributions. Now, you should be aware that this presents a potential mixed bag of tax consequences. It will benefit you most likely on the federal side, but it might not benefit you on the state side. It's the idea of bunching your charitable contributions in a single tax year so that you get the best bang for your buck and you take the full advantage of your standard tax deduction. All right, so let's assume in our example here that we have a taxpayer who's married filing joint and has adjusted gross income of $125,000. The effective tax rate that this individual is going to have in this range is around 15%. Now they're going to be in a higher marginal bracket, but the effective rate will be about 15%. So if in 2018 and 2019 this taxpayer has the same itemized deductions of $25,000, which you can see here, they're only receiving a benefit. There's really just a delta of $1,000 here between the standard deduction and your itemized deduction. And it's the same in 2018 and 2019. So, let's suppose that instead of making a 2019 charitable contribution in 2019, this $6,000 in 2019, let's suppose that they're going to not make this contribution in 2019. They're just going to bring it forward and make a $12,000 contribution, $6,000 at the end of 18, and then they're going to just prepay whatever they're going to pay in 2019. Your itemized deductions for 2018 will move up to $31,000, changing this delta to $7,000, which is more beneficial. And you're going to lose the deduction over here, and this will change to $19,000. Now, do you get $19,000 as an itemized deduction in 2019? No. You get the higher of the standard deduction or itemized deduction. So in this case, we've got $24,000 deduction now in 2019 and a $31,000 deduction in 2018. Now, if we apply the rate of 15% to the net change in 2018, saving about $900 in 2018, compare this to 2019, where they have $1,000 less in deductions because they're now utilizing the standard deduction of $24,000. They've lost about $150 in deductions. So you have a tax savings over here on the federal of $900, and you've lost $150 over here. So that at the end of the day, your net delta is a $750 net change. You've saved $750. Well, this works well for federal purposes, but you really have to keep in mind the state tax implications. And that's why I say this can be a bit of a mixed bag. So many of the states have a much lower standard deduction than the federal standard deduction, meaning that the states in 2019 will still itemize, and they have lower deductions to itemize because you're taking $6,000 from one year and moving it to another. It's possible that the state income tax effect on this tax planning will make it not beneficial enough to move forward. If you would like us to run some analysis on it, whether this planning point makes sense for you, send me an email. Because we're recording this webinar in 2018, this scenario uses 2018 and 2019, but you should know that this plan can work for other years as well. This particular analysis, I would just give you a spread over a couple different states. It saw a reduction for Maryland residents of about $541 over the 2-year period. DC residents saw the greatest benefit because they have a much higher standard deduction, and so their reduction was $2,207. And then Virginia saw a reduction of tax of about $266. So it's worth parting with, that's where you have to decide, is it worth parting with $6,000 early? For the DC resident, I would say it might make sense, but you should definitely reach out to us to see if this meets your criteria. And the facts, again, in this case were a married filing joint, $125,000 AGI, and itemized deductions that closely mirrored what the standard deduction was. If your itemized deductions are way above this, this isn't going to work for you. If they're way below this, it's not going to work for you. Just want to draw your attention to the personal exemptions and the changes that have taken place here. There's just not a whole lot going on here because the personal exemptions have been repealed. There's no longer a personal exemption. Now, if your AGI in the past was over about $436,000 and you were married filing joint, and if you were over 384 and you were single, this exemption was phasing out for you anyway. So the fact that it's been repealed altogether doesn't affect you at all. If you were under that AGI threshold, you did get the deduction. And what tax reform really sought to do was simplify parts of the tax code. And they essentially rolled this exemption into the reduction in tax rates. Now, if you have kids or other dependents, kids are, any kid that would qualify for the child tax credit is going to be a kid under the age of 17. 17 and up is going to get other dependent credit as long as they meet the applicable tests. They've mitigated the loss of this exemption by adding those tax credits. The child tax credit, they didn't add, they just doubled it. And they also made it, the AGI thresholds and the phase outs for the child tax credit have almost been quadrupled. So if you weren't getting that credit in the past and you're under this level, you're going to see substantial credit there. So they've tried to mitigate the loss of this exemption with the tax credits, the child tax credit, which is more beneficial. Credit is a dollar for dollar reduction in tax, whereas an exemption is just a reduction of your taxable income. The increase in the phase outs from the child tax credit and the increase in the amount of the credit, as well as the addition of the other dependent credit, which is the $500 credit that you can get, they should benefit you more than the exemption ever did. Now, if you'd like more information on the child tax credit and the other dependent credit, please go to our web page, and I'll show you this on the next slide. And that's all for our tax topic today. But if you'd like other mini webinars like the child tax credit webinar that I just mentioned, just come here to this grfcpa.com, go to resources at the top, and go to on demand. And we have quite a few different tax topics there that you can listen to. And if there's a tax topic that we don't have there that interests you, that you'd like more information on, please just feel free to shoot me an email and we'll create a mini webinar for that. We want topics that actually interest people. So that's what our goal is. I can be contacted at sboisvert@grfcpa.com. And if you would like to call me, you can call me direct at 671. Thanks for listening.